Joining me now is Brian Reynolds, the Chief Market Strategist at Reynolds Strategy. Brian, it's great to see you. And we should add, you're not an economist. You're approaching this from a market point of view. And what does it tell you?
It tells me that the economy is probably better than the published figures say, and it's more productive. People are quitting their jobs and they're launching their own companies at a record pace.
What about the boomerang effect of people who go start a company, realize it's a hassle, and then they want to come back into the workforce?
That could happen, but I doubt it. If you look at the economic history after pandemics, and I've studied a paper at the National Bureau of Economic Research that looks at the last 19 pandemics, going back almost 700 years to the Black Death in 1331, the economy changes dramatically in the 10 and 20 years after. This isn't a 1 or 2 year thing. This is a decade or 2 decade shift. And people are making more money by leaving their job and setting up their own shop. They don't have to share their revenue with their bosses above them or the shareholders. They are the shareholders. So that's great for wages. That's traditionally what happens coming out of a pandemic. Real wages go up. The economy gets better because productivity goes up. You're much more productive if you're running a small firm than a large one. You don't have to sit in all these boring status meetings on Zoom. You don't have to deal with these human resources bureaucracies. There's a reason why the TV show The Office was such a hit, and it's still in demand, even though it hasn't been in production for years. Your parent company, NBC, took it away from Netflix to put it on their streaming app, Peacock. And that resonates with a lot of people.
Absolutely. It's iconic. I was even going to trace it further back to Office Space, which really kicked off the whole sort of frustration movement. But again, I think the point here is that you think maybe this isn't being captured in the Labor Department data. We've gotten one jobs report after another with these misses, at least on the payroll side.
Well, the payroll data, which is what most people in this business look at, comes from the Bureau of Labor Statistics, which is under the Labor Department. The new business formation data comes from the Census Department, which is under the Commerce Department. Those are two silos. And in Washington, silos tend not to talk to each other. So it's harder to access the new business data. Everyone's looking at the payrolls on their screen. The new business data doesn't appear on any trader's screens. So you have to really dig for it. And this is a historic change. As you said, it's 50% more than what we saw going into the pandemic. That's 5 million new companies a year. And we're 4 million down in employment from the peak of 153 million before the pandemic. That's likely where a lot of these jobs have gone.
So let's talk about the markets and where this leaves you on them. I mean, you've been consistently bullish on stocks throughout this rebound. Where are you on stocks overall? And what would you say to people about the value versus tech trade?
We're in another credit-led equity bull market, just like the last one that lasted 11 years going into the pandemic. And this is partly why the reason why the bond market hasn't freaked out. Because they know that productivity is better than the published numbers. They know the economy is stronger than the published numbers. Even the published numbers, GDP is at a new high while payrolls aren't. So we're doing more with less. And that means the credit market is flooding companies with all the money they want for stock buybacks. Stock buybacks have hit a record. Retail investors hit a record, but they flattened out. Institutional investors have become bearish and big sellers since the mid-half of 2021. And so the result is we're in a long-term bull market with more volatility this year than we saw last year. You get these little dips in the stock market like we saw when the Fed was more aggressive last week. But the credit market didn't miss a beat. Credit investors have bought over 120 billion of new corporate bonds in just 8 trading sessions this year, and they're buying even more today. A lot of that money is going to go into buybacks. Yeah.
And final question on the retail front, because you have been tracing, retail flows and how much they've been a part of this rebound. Is it possible? I don't know how, I'm just curious based on your sense of things that boom is over. I don't know. Maybe it's because there's, the jobs are getting more demanding now. There's, we have the reopening. I mean, what do you expect in terms of retail participation in the market this year?
It's going to stay strong, but not much growth. Option volume has tripled from what it was in the decade prior to the pandemic. But now it's flattened out at that higher level. So it's still a source of strength, but not as growing as rapidly. I don't think it's going to be a source of weakness. I don't think these people are going away. But now we're being led by the credit market. The buybacks are at a record, and that's what's really driving these stock prices higher with some more volatility driven by institutions.
Yeah, absolutely. Brian, thank you. All-encompassing chat there. It's good to see you.
Shepard Smith here. Thanks for watching CNBC on YouTube.